All right, guys, welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited you have joined me today. Um, this show we do live every Tuesday to help you learn the ins and outs of passive real estate investing so you can achieve your financial freedom goals. So if you haven't done so already, make sure to check out PassiveInvestingWithWhitney.com. There I have tons of free resources for you, as well as you can hop on my calendar. We can talk about how we here at PassiveInvesting.com can help you achieve your financial freedom goals. And that is a great place for you to check out our open deals as well. Now, if you didn't catch that, that's PassiveInvestingWithWhitney.com. Now, today we're going to dive into a little bit different of a topic because we talk a lot about equity investing, but really today we're going to talk about how to use debt funds to achieve your long-term retirement goals, financial freedom goals. Now, we are specifically going to look at a model of like how you can take $150,000, add to it over time, and turn it into $1 million in a very short time period. Now, if this is the first time we're meeting each other, again, my name is Whitney Elkins Hutton. I'm the Director of Investor Education here. And, if you're watching the show live on YouTube, you're seeing pictures of my family here. This is the whole reason why I invest passively in real estate in general. I started off in 2002 completely as a live and flipper, house hacker. Then eventually scaled my portfolio with single family rentals, multifamily deals, and then into multifamily partnerships. But while all of those active activities were helping me build equity, what I didn't have was my time. And so, really, it was actually investing a lot of that equity that I was bringing in into passive deals. That's really where the golden handcuffs broke for me. I was able to unshackle those chains. And fast forward today, my husband and I, we have well over 6,500 multifamily units, 2,200 self-storage units, and myriad of other cash flowing investments. More specifically here, related to our conversation in express car washes. But again, it was those passive investments that led us to a result, which is having 100% choice and freedom on how we spend our time. Now, here's the thing. I still work, but so does my husband, but we love what we do. I get to spend my time here with you guys, helping you understand how to unlock financial freedom for yourself. All right, and we can actually help you do that here at PassiveInvesting.com. We've lent over 300 and actually 50 million in our rehab wallet loan lending arm, as well as has made placed over 1.4 billion or have more than 1.4 billion in assets under management on our equity side of the business. Now, we are going to do a little bit of math today, but I just want you to know these webinars we do for educational purposes. So it's not financial advice, not legal advice, not tax advice. Make sure that you are still building and consulting with your investment team before making any investment decision. Now, I'll put up my contact info, at the end, but I know everybody's time's precious. This is my invitation to you to join our passive investing club. Again, you can get a free one-on-one call with me, discuss your investing goals, free access to educational masterclasses and boot camps, and priority access to our deals. Now, if you're watching this live on YouTube, you see a QR code, but if you're listening to us on your favorite podcast player of choice, you can go to the show notes or go to PassiveInvestingWithWhitney.com. And here, a lot of what we're going to talk about today is covered in my book, Money for Tomorrow, where you can order on Bigger Pockets. Now, we're talking about how to build wealth in a debt fund. And I always like starting at the very beginning. So let's get everybody caught up and exactly define what is a debt fund. Well, a debt fund is simply an investment fund that specializes in providing debt financing to real estate related projects or investments. Now, instead of investing in just one mortgage or one real estate note with your own money, I mean, you can do this on your own. This allows you to actually invest into a pool of assets. Okay. So multiple mortgages within a fund. Now, the cool thing here with real estate debt is that it tends to be pretty on the lower side of the capital stack, meaning we're in the senior debt or mezzanine debt position. So, in theory, we're in the lowest risk, quote unquote, lowest reward position. Okay. Now, I'm going to bust that myth because not all debt's created equal. But what makes the debt really attractive right now is where we are at in the market cycle. Now, we're recording this in October of 2024. We just recently had a 50 basis point rate cut by the Fed. Now, we are thinking that, interest rates are going to fall, which actually they have fallen since the summer of 2024. The market has baked in this rate cut. We are looking forward to having future rate cuts. But really, where the debt fund structure really takes advantage of is this part of the market cycle, which is the hypersupply into the kind of the recessionary period where credit is less available. And I would also argue it takes advantage a little bit in the expansion side because not all markets are cycling exactly the same, meaning that the real estate market in San Francisco cycles a little bit differently and at a different time than the real estate market on the East Coast. Okay, so each geographical area in the United States is going through some part of this credit cycle, which overlays very well with the different four phases of market cycles. Now, when less credit becomes available, banks are pulling back, and this allows the investor, private investor, the opportunity to become the bank, which makes debt funds very attractive. Okay. And essentially, what are we doing? What we're trying to do as real estate investors, we're trying not to compete. And so, in this part of the cycle, we're trying not to compete with the bank. We don't have to. Whereas, if we're in the expansion phase, in the growth phase, or the recovery phase into the expansion phase, now we're competing with the bank. Now, like I said, I showed you the image of a capital stack and how debt plays into the lower tiers of the capital stack. But just because you're investing in debt doesn't mean that it's actually low risk because there's all different types of debt funds out there. There's some that are on primary mortgages, commercial debt, residential debt, distressed debt, private debt, crowdfunding debt. So it comes in all different flavors and sizes. Now, I love utilizing debt in part of my portfolio for a couple different reasons. But really, I use it as a diversification play. Okay. And the reason why I love it as a diversification play is because it helps me create a cash buffer in my portfolio because as markets cycle, we have all learned over the past 2 or 3 years that your equity investments are going to go through different phases and different percentages on how much they actually cash flow. um, so the debt allows us to create this cash buffer in there. Okay, we take advantage of some of the biggest market fundamentals. Okay, if you watched my webinar that I did back in September, we covered some of the market fundamentals that are putting pressure on residential housing, which makes residential housing in the United States a very good bet for the next 7 to 10 years at minimum. But one of those large market fundamentals is that we're generally undersupplied. Now, depending on who you're listening to, we're either undersupplied by 3 million homes upwards to 10 million homes. And it would take 5 to 7 years to solve that issue if we were building today. But the problem is, remember, the credit has been sucked out of the market cycle, and a lot of building has stopped. A lot of construction has stopped or severely slowed down. So again, debt allows us to take advantage still of real estate market fundamentals. We're in that low position in the capital stack. We can create reliable cash flow here through fixed stable income. We can also create that cash buffer. So, you can get potentially a monthly distribution with the debt fund that you're going into. If you don't need the cash flow, this is something that I'm talking to investors about all the time. They were like, hey, I want to go on this amazing equity deal. I don't need the cash flow right now. But what happens in 2 years if your job situations change and all of a sudden you do need the cash flow? Investing or creating a diversification with debt funds in your portfolio allows you to flip that switch, okay, to consume the cash flow if you need it. Now, you can actually put it to better use, those monthly distributions, by allowing them to compound and grow faster. Okay. It also, by creating this diversification within your portfolio, creating that cash buffer, if we do hit a challenging market, now you've got this cash sitting on the sideline that's performing or being put to work and performing very well. If you run into challenges with other assets, you're not going to be forced to sell them in a down market. You can utilize some of the cash that's being thrown off to help prevent from forced sales. Okay. Also, debt, depending on what asset class you're going into, can be relatively non-correlated returns with other parts of the real estate market. But what I really love about debt funds is that with one capital placement, and it has to be in the right debt fund. I'll show you some comparisons here in a little bit. You can get instant diversification over borrowers, markets, and deals with one capital placement, as opposed to if you try to write and originate your own notes yourself. You can do this, but you're going to have to make a larger cash outlay in order to get similar diversification. But what makes that really, really attractive is the capital preservation piece, meaning that the lower in the capital stack that we are, the closer we are to being in a first lien position, does put us into a priority position in case something happens with the asset, like if it goes into foreclosure or bankruptcy or just the borrower is underperforming. Now, I wanted to touch on what debt funds were, why they are super attractive in this particular market environment, how they can create diversification in your portfolio, give you a little bit of insight on how I think about them and how I use them. But a lot of reason why people don't go into debt funds is they're like, I can't grow my portfolio that much. I've got this goal of creating tens of thousands of dollars of cash flow annually, and I just don't see the path if I did that through debt funds. And I wanted to dispel that myth because what is the number one thing here with debt funds that makes them perform very well? And then that is time. And so again, this is having the long view, or what I like to call cathedral thinking with your portfolios, to continue to set aside money. Say like you're investing $150,000 a year, continue to put a third or fourth of that into debt funds every year to continue to build up that cash flow buffer. Okay, because then it'll just kind of like smooth the ride in performance. But I wanted to give you a clear visual on what it would look like if you tried to retire, say, like in 7 years using debt funds. In this particular situation, if you guys are watching with me on YouTube, we have an initial investment, say, of $500,000. Okay, maybe somebody is utilizing their self-directed IRA account. They've built up a healthy IRA account. They're just like, man, I need to push pause for a second on the equity. I need to create cash flow stabilization for myself. Maybe I'm really close to retirement. Let me move this chunk of cash into debt fund instruments. At $500,000 dollars invested, and I'm using this example with our debt fund metrics, you would earn a preferred return of 9%. And then let's say like every year you're just adding $100,000. Maybe that's what you're contributing to your retirement account. And you just add that $100,000 a year. For the next 7 years, you could build up a equity bucket of 1.6 million over 7 years that kicks off $161,000 a year. Okay. Now, if we expand that out to 10-year timeline, okay, that bucket would be $1.9 million. So you can build equity. Now, I guess my question here for you is, what pays the bills? What will allow you to get to financial freedom? Is it having the large bucket of money in the retirement account, or is it having that consistent cash flow coming in? And this is where I really challenge my investors that I work with in a coaching relationship. Sometimes we can achieve the goal, with far less risk. Now, I also wanted to show an example of what if you had a smaller amount to get started with? How quickly could you build up, say, like in 7 years? Now, year one, maybe we're just putting in $100,000. Maybe you don't want to make a large chunk movement over to real estate debts, but you're like, Whitney, I see what you're saying. What you're saying, I'm feeling you. I need to start moving a little bit of my equity over there. Well, in our debt fund, you would earn 8% preferred return. And if we just continued to compound our investments, our distributions back into the fund, we could essentially by year 7 grow over $906,000 in equity in that particular investment. And it can be kicking off $81,000. Now, if we let that roll out to 10 years, now we've got 1.2 million sitting in our account. All right. So again, you can create stabilized income, grow your equity. It just takes time. So the beauty is here, what we are tapping into here is compounded growth. Okay. And so here is another way to look at it. 100,000, this example just looks at an initial $100,000 investment, no other capital outlay at all, just one simple $100,000 placement. At the end of 10 years, you've taken that $100,000 and more than doubled it. Okay. Your capital balance would be $221,000 if you allowed it to compound, which equals an effective annual return of 17.01%. Okay. And that is with being in the lowest rung of the capital stack and taking minimal risk. All right. Now, again, I wanted to put this in front of you and show you illustrations that, for what really just to illustrate to you that it is possible to retire using debt funds. But we got to be consistent. We got to build it early. And we got to allow time to work on our side. I think that's the key to investing, period. But we really do need to do that with debt funds. Now, not all debt funds, as I alluded to, are created equal. So we need to look out for some key components here. Okay. So I love looking for debt funds that take on a first lien position. Okay. Meaning that if something goes wrong with the asset, okay, and the asset has to be sold, the note that fund wrote to the borrower gets paid off first. Okay. It's not sitting in second position. It's not in, some other risky part of the capital stack. I also love taking advantage of very simple market fundamentals. We are undersupplied on residential housing. Okay. Our particular fund takes advantage of single family residences. How can we do fix and flips in these areas and provide quality housing to people? Okay. Also with the debt fund, I look at the diversification of the debt fund. Now, there are other funds out there where you can get some juiced returns from the very beginning, but you got to be careful because they might be mixed, take mixed positions in the capital stack. They might do a little bit of development too. Okay. They might be mixed across asset classes, that you might not want to be exposed to. Also, they might take larger capital positions in asset and have fewer loans, meaning the diversification isn't really there. All right, next part is you have to match the debt fund distribution to what the cash flow needs that you have. And for me, I am very accustomed to getting in monthly income. And so that's why I like looking for debt funds that throw off monthly cash flow or allow me to compound. All right. Now, here's a critical piece. When you look at a debt fund, we also want to look at the default rate. Now, the industry standard for debt funds is a 1 to 3% default rate, meaning that whoever's originating the debt is looking at the borrower and they're thinking out of 100 borrowers, 1 to 3 of them aren't going to perform. They're baking that into their numbers. Now, that's good if they're actually accounting for that, but why not calculate your numbers off the industry standard, but the debt fund actually aim for 0. Okay. And so we want to look for a very minimal default rate. Now, in combination with the default rate, we also want to ask the question, Has there been any deficiencies? So if a borrower defaults, does the fund actually lose? Or was the fund able to take over that asset and actually reposition it and earn more money for the investor? All right. Now, a couple other things that I look for, lockup periods. I'm not a fan of lockup periods. You'll find a lot of debt funds out there that have a 6 to 36-month lockup period plus a 90-day redemption on top, meaning that if you put your investment in, you might take you 99 months to get your money back if you needed it for whatever reason. I like debt funds that give me some flexibility, right? Maybe I've got a tax bill that I need to pay, or maybe I have a capital need on another asset. Okay, I like debt funds that give me some sort of flexibility there. Now, this is probably the most important key when I look at debt funds. I want a debt fund that has zero leverage, meaning they're not taking my money, going to the bank, getting another line of credit, and then lending out that line of credit. I want to, keep it very plain vanilla, minimal risk, and use as minimal leverage as possible. Okay. And then, like multifamily, I want to understand how many loans in that fund actually have to perform so I get a return as an investor. All right. Now, a lot of other funds I've taken a look at, it's somewhere between 65 to 80% of the loans have to perform in order for the investor to get the return. For us, only 55%. So that's a nice, healthy buffer there. Now, again, I wanted to illustrate for you how you could retire utilizing debt funds. If you are interested and want to learn more about the passiveinvesting.com real estate debt fund, be sure to reach out to me at passiveinvestingwithwhitney.com, or you can email me at whitney@passiveinvesting.com. But if you're watching on YouTube here, I'm showing you, some quick stacks on our fund. Preferred return is 6 to 10%. And everything that I just talked about diversification, not being levered, how, the break even percentage that we have on our particular fund, and the ability to compound. Now, from an educational standpoint, when you're considering adding a debt fund position to your real estate portfolio, at the end of the day, it all boils down to your goals. All right. I love asking my coaching clients, what part of your financial journey are you in? What are you trying to hit? What's that next milestone? Is it security, vitality, independence, freedom? All right. I think having a stabilized cash flow income or a stream of it in our portfolio, whether you need it or not, is super important for all different stages of your financial journey. And if you don't need to consume the cash flow, that's fine. Just pump it right back into your portfolio and grow it. Also, what do you need from your portfolio today and in 10 years? This is an important question because cash flow and diversification are needed across all timeline horizons in a portfolio. But the last question I'll leave you with when you're considering your goals is, what kind of risk are you willing to take in order to achieve your goals? All right. Again, diversification through debt funds allow us to smooth that ride, because it may not mean us building the largest bucket of cash. It might mean building the largest bucket of cash flow. All right, guys, thank you so much for joining me today. If you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show. All right. Thank you for hanging in there with me with all the technical difficulties at the very beginning. So sorry, guys. I don't know what happened there. All right. I would love to understand, one, what did you love? What did you love to see? Or what would you love to see in this presentation? Because I'm always looking to up level the presentations that I bring to you. Two, I want everybody that is on here, everybody, tell me one takeaway you got from today's video. Okay, because whenever we think about the takeaway, that's when we're going to think about, oh yeah, that's how it can fit in my portfolio. We can actually start creating an action plan around it. If you start going, okay, done, webinar done, and leaving, okay, we got to put the this good time and all this education and knowledge to use. So go to your chat box or your Q&A box and let me know. Okay. And this is the amazing time for you to be asking questions. It can be related to debt funds, equity, it doesn't matter. We're all friends here. So fire away. And a couple of people just joined in. Yeah, well, we're in the Ask Me Anything part of our show. You guys, if you have any questions, I'm going to hang out here for another minute or two. Go over the Q&A box or the chat box. Let me know what you love, what you'd love to see from today's presentation. What are you taking away from today's presentation are going to put to use? And if you got any questions, let me know. All right. I'll give it just a little bit more time. But it seems like I answered everything for you. That's amazing. Questions specific to debt funds are helpful. Okay. I got value out of understanding default rates, leverage, and the number of contracts needed. Yeah, there's no one size fits all. It's a matter of you understanding the different risk. Okay, so let me put this in context. I I was looking at a debt fund and that came highly recommended. And when I love the returns and I started digging in a little bit more and I was like, wait a second, how big are the loans? And they were like $460,000. I'm like, huh, how many loans do you have in your fund then? Because I knew the size of the fund and I could do the back of the napkin math. And they were like 30. And I'm like, hmm. So really, you just need 10 people not to perform, and I no longer get a distribution. Whereas if you have, like in the case of the passiveinvesting.com real estate fund, and I'm just using that for comparison, we at any point in time might have over 400 loans in the fund. Okay. And at a smaller dollar amount, say like at $160,000. Okay. That's far more affordable for people. Okay. They're probably not going to let, you know, you know, it's going to be much more achievable for them to pay off 160 than the $460,000. They're less likely to give the keys back to the bank. But it's not just the number of loans. It, like you said, it is comboed within default rates. What was the loan to value on the property? Like there's other factors here that we want to take into account. But for me, if I'm going to make a diversification play like this, I want to make sure that there are multiple borrowers across multiple markets that are feeding into that fund. Awesome. Well, guys, if we don't have any other questions, I'm going to give you guys time back on the day. I really appreciate you hanging here with me and investing in yourself. All right, guys, take care. We'll see you next week.